10 stocks to buy now, or maybe even add to your watch list. That's what we're getting into here today, folks. Some very cheap stocks. And many of these are not stocks I've ever spoken about on the channel before. But we got a tremendous amount of buying opportunities in the market right now. And the stock market has been, I would call it, a bit of an illusion in 2023 so far. Because you've watched stocks like, let's say, Apple, Microsoft, Tesla, Meta stock, Nvidia, AMD stock, some of the biggest, let's call it tech conglomerate companies, right, actually prosper and do very well so far in the trading year, right? But it's given an illusion around the stock market that like everything's doing great. In reality, pretty much every single stock I'm going to share with you in this video, all 10 of these stocks, are at 52-week lows, very close to 52-week lows, and many of these stocks are either at all-time lows or multi-year lows. One of these stocks is the lowest it's been in over a decade, okay? So there's a lot of opportunities out there in the market, and don't get confused and think like just because there's a few stocks at the top that are doing well this year, there's no other opportunities. I'm telling you, 2023 is a year of massive opportunity in the market. It's just you got to look different places than the most famous stocks out there on a year like this. So hope you guys enjoy this video as always. I appreciate everybody joining me. Thanks for being subscribed here. Thank you also everybody that supports the channel on Patreon. I just made 4 moves in the Patreon portfolio here today. I just posted those moves up a few hours ago. If you want access to all the moves I'm making out there in the market, check out the pinned comment down there. That'll be to join us in the Patreon down there. We also have a Discord chat now if that's something you're interested in joining there, okay? Alrighty guys, first stock up here is a fertilizer company named Mosaic Company. Ticker symbol MOS on this one. This stock has been heavily damaged, and it's sitting right about at a 52-week low right now, and actually a multi-year low for this fertilizer company. Now, in regards to this company, the stock is trading at about $43 a share here today. It's about as cheap as you can possibly get. I mean, the PE ratio is 4 on it right now. Now, the earnings per share for Mosaic had been about $10 roughly for the trailing 12 months for this company. Meanwhile, their dividend, they don't even pay out a dollar of dividends, and you get almost a 2% yield. So which means basically they have a lot of room for upside dividend increases in the future. Now, do keep in mind when this business is very bad, the stock can be hit very heavily. In 2020, the stock price fell all the way down to $10. Now, is this stock going back to $10 even in a rough market? No. But can the stock go down to $20 or $30 if things get really bad for them? Absolutely. That's definitely a possibility. And so this is something to kind of keep in mind with a company like Mosaic overall, okay? Now, recently, the stock has been falling even more because they just got downgraded here, okay, from neutral. So they had an outperform rating, JP Morgan did, right? But now they put them to neutral. They said that the fertilizer makers' profits will likely decline as commodity prices fall if China resumes exports of raw materials and in Ukraine ends. There's a risk to Mosaic's share price if the conflict in Ukraine comes to an end, if China government policy changes lead to increase phosphate exports, if Belarus increases potash exports through Russia, and if grain yields in the United States improve here. So a lot of things could be potentially, keyword is potentially, working against Mosaic in the short term, which could hurt their profitability, right? And they believe the stock should be about $46 a share. They previously thought the stock should be $60 a share in regards to this, right? And this is the numbers in relation to Mosaic that JP Morgan has. Basically, they thought they were going to do $7 plus in EPS for 2023, 2024. Now they're expecting $5, right? Which is still impressive profitability for a stock that's $43 here today, right? That's still a P ratio well under 10 on this stock, which is incredibly cheap for Mosaic overall. So the thing to remember with a company like Mosaic, though, is you're likely going to make good dividends over time, but capital appreciation in the stock, meaning the stock price going up, it's going to be all over the place, okay? And it's going to depend upon so many factors that is out of Mosaic's control, okay? And so every company has to deal with, let's call it, things that are out of their control. I just feel like for a company like Mosaic, they're going to have more of it. So, which actually gives some incredible buying and selling opportunities for a stock like this if you're interested in a company like that. But at the end of the day, it's a needs-based company. It's going to continue to be here regardless of if we have a good economy, bad economy, okay economy. It's needs-based, and they're going to continue to put up their numbers. It's just a question of, is this a company that does $3 EPS, $5 EPS, $7 EPS, or $10 EPS, right? And so So anyways, that's a very interesting stock there that I think is definitely a tremendous opportunity in 2023 here, okay? Second stock up here is Whirlpool, ticker symbol WHR. This is an appliance-related company. They make everything from refrigerators, washers, dryers, ovens, microwaves. Like, it's incredible, right? And so in regards to Whirlpool, this is a stock that's trading literally right now pretty much at its 52-week low and actually a multi-year low now at this point in time for Whirlpool, okay? Now, this company is dirt cheap. Let's call it what it is. It's dirt cheap. It's a forward P under 10 for this stock. A price to sales ratio of 0.3 on this company, 0.3. So we're talking about a dirt cheap company here. But something that I think is worth addressing here is the fact that we're likely going to have a slower residential real estate market for maybe at least the next year, if not next couple years, okay? And it depends on how long this will last. But there's not going to be a ton of people moving around over this next, I'd call it 1 to 2 years, and there aren't going to be a ton of new homes built over the next 1 to 2 years, okay? Or apartment complexes, things like that over this next 1 to 2 years, okay? And so that's going to hurt Whirlpool's business overall. And if we look back to slower time periods for this company, which we can look back to the Great Financial Crisis, you can see what happened to the company's net income, right? 2007, they do $640 million in net income. By 2009, a couple of years later, right? Half that, roughly, $328 million of net income. And if you look at just slower years in general, $400 million-ish of net income. So you got to understand, like, this company's been producing $1 billion, $2 billion, nearly $2 billion of net income, but it's very probable that over this next couple of years, they could go under $1 billion, and it's a possibility, okay, keyword is possibility, that they would go back, if things got really bad and really slow, they could go back to the $400 to $500 million net income range, right? Now, if you think about it this way, right, if you say this company's going to earn $400 million, which is a really, really slow, let's call it residential real estate market, right? And the company's doing $400 million in net income roughly, and you slap a 12P on it, which is pretty fair for a stock like Whirlpool. This isn't the type of company that commands a 20P ratio. It's never been that company. It's not going to be that company. So they could command like a 12 is realistic for this company, right? It's about a $4.8 billion market cap. So just do understand, if things got far worse, this stock's going to fall likely to about a $5 billion market cap, which means there's lower to go here, okay? But that's assuming, once again, things got really, really bad from here. If things kind of stabilize over this next year and pick up, then you're likely looking at the stock hitting lows right now, or likely over the next, I'd call it 1 to 2 months here, okay? So that's kind of the way to think about that one. Whirlpool's definitely a great opportunity, huge dividend payer. So the great thing with Whirlpool is, even if you're in, let's say you start to buy this stock and you start to accumulate shares, and let's say the residential real estate market continues to just be in a slower period here for a while, the great news is you're going to make terrific dividend money on this while you're waiting for that residential real estate market to come back, so you can get some nice capital appreciation on the stock, right? Which is one of the beautiful things with my strategy in the stock market: growth, value, dividends, right? GVD 1, 2, 3 is, you got to take advantage of different opportunities in the market, and having that dividend money come in when maybe the shares aren't going up is a phenomenal thing, okay? Number 3 of 10 stocks up here is a company named Stanley Black & Decker, ticker symbol SWK. It reminds me of a ticker symbol of another stock I own, Skyworks Solutions, which is SWKS, okay? But Stanley Black & Decker, I'm sure a lot of you guys know that name just by me saying it right now, okay? This stock has been absolutely pummeled. It's in a horrible place. I mean, absolutely a horrible place at this point in time. Stanley Black & Decker, if you didn't know, they own many different brands outside of Black & Decker, right? Black & Decker, DeWalt, Craftsman, Stanley. I mean, if you work in any field, let's call it that's in the construction industry or anything, handyman work, like anything like that, right? You even do work around your house, you know these brands. Like, you ever been to Home Depot in your life, or Lowe's? Like, you know these brands, okay? Very, very famous brands overall that this company owns. This is just completely random. I was just looking around at some of their products. Do you know they got a cocktail machine? What in the world? You'd be flipping my flapjacks. That's the most random thing I ever seen. I think I'm going to buy a few people that for Christmas, because I was like, that's so random, okay? Now, in all seriousness, in regards to Stanley Black & Decker, this company is in a bad place short term with their profitability. They're making a bunch of changes with their business model. They're laying off some employees. They're basically resizing the company. And this creates a lot of problems for your profitability in the short term. Long term, it's a great decision, but short term, it messes up your numbers. So right now, the company looks like it trades at insane trailing Ps and forward Ps, but likely it's going back to these sorts of ranges over this next, let's call it 12 to 24 months here. And if you look at what analysts expect, right, 2023, yeah, it's a disaster year as far as their earnings per share with all the changes they're making right now. But next year, they're expected to get back to normalized situation. Now, if the construction industry continues to slow, maybe they don't do a $5 number. Maybe they do a $3 or $4 number. So it is a risk factor you kind of got to think about in regards to a company like Stanley Black & Decker, right? Now, here's also something I thought was troubling with Stanley Black & Decker, okay? And it just kind of shows me that there's likely a little mismanagement going on, and they're trying to fix that now at this point in time. Check out the revenues. $10.8 billion of revenue in 2013. They do almost $17 billion of revenue in 2022. That's about a 60% up number or so, roughly there, right? But then you look at their gross profit, and it's not up nearly as much. I mean, we're talking about going from 393 to 44. So basically the percentage gain in gross profit hasn't been even remotely close to what you have seen in revenue over time, which is troubling. That's the best way to put it. That means they likely have competition in, they're likely facing competition. Obviously, inflation's probably hurt them as well. But it's something I thought was interesting, right? Now, Stanley Black & Decker said it's closing factories in Texas and South Carolina, relocating some operations to Tennessee facilities as the company revamps its manufacturing and distribution network. The Connecticut-based tool maker said the moves would affect about 357 employees, right? These actions are aligned to the transformation strategy designed to deliver $2 billion of cost savings and are reflective of the current economic conditions. So basically, this company is expected to, like many companies in the market right now, get themselves in a position where they're going to be much more profitable over the next 5-10 years than they've been over the last 5 to 10 years, which I think is a healthy thing overall. So for a company like Stanley Black & Decker here, this one ultimately, I think, is a great year to be a buyer of this stock. This stock's, look at this. This stock in 2012, right, was $70+ stock. So basically, the stock is the lowest it's been in over a decade, right? Over a decade low for this company. And I look at years like this as these are kind of freak years for a stock like this, and you've got to take advantage if you're interested in a company like this. This is your time period to take advantage. When everything looks great again, and they've already got done all their moves as far as employee cuts and switching facilities, and once all that's done, and then the economy's on its 2 feet again, and there's more, let's call it clarity out there. Do you think this stock's going to still be a $70 stock? No, it's not at that point in time, right? And so that's just something I think is important to kind of keep in mind there. And I actually look at this year as a pretty good opportunity to take advantage of a stock like this. And look at that dividend yield, 4% dividend yield there, which is very, very nice for a company like this. So yeah, Stanley Black & Decker, I think it's a great year to be a buyer of this stock, right? Avon Brands, the smallest cap company I personally own, right? Number 4 of 10, this stock has been absolutely pummeled, and it hasn't deserved to get what it's gotten, essentially. Okay, there's a lot of smaller cap companies that deserve to get absolutely pummeled. In this market, I can tell you this isn't one of those companies. When you see these sorts of moves there, right, you're like, oh my gosh, it must be in a bad position. This company right now, okay, is basically, it has about $35 million of stockholder value, stockholder equity, okay? Stockholder equity of about $35 million US. That's less than the market capitalization of the company right now. You don't see that very often, if ever, with a company. And if you ever do, it's usually because the company is, the revenues are plummeting and people think they're going to go out of business or something like that. That's not the situation with Avon. They're actually cash loaded when it comes to this company, right? As well as they got a lot of inventory because they've been growing their business. But not just that, the company's a growth beast. And so this is the furthest thing from a company that should be trading at basically stockholder equity, stockholder equity being higher than the market cap right now. Like that should never happen for a company that has this sort of growth. That's just ridiculous, right? They did $22 billion of revenue this past year versus $11 billion the previous year. That's incredible growth for an MJ company like this, right? Now, in terms of their bottom line, right? It's being hurt by a few things. Depreciation and amortization definitely hurt them. And also share-based payments this past year definitely hurt them as well. But if they can get on their own 2 feet as far as that net income loss goes, oh my gosh, the upside here for Avon is absolutely ridiculous over the next several years, right? And so the way I kind of see this stock playing out is I think it's going to bottom likely here in the second quarter of the year, and I think it's going to start to uptrend in the second half of 2023 and kind of move from there as they continue to make progress on the bottom line there. And if they can start showing profitability for this company, I mean, imagine if they can just get to a point where they start throwing off $1 million or $2 million a quarter in net income. I don't think that's out of the realm of possibility for them to get there pretty soon, right? And I mean, when you start thinking about if they do 1 to 2 million positive net income a quarter on a market cap of 32 million, do the math on that and run that over a year, and you begin to understand why this market cap could explode higher over the next few years if Norton and the team can kind of put together what I think they can put together as far as that bottom line coming together. So yeah, I think this one's a tremendous buying opportunity for if anybody's actually interested in something super small out there. It's definitely at least a stock to watch, right? Fifth stock up here, Dutch Bros. This is a stock that pretty close to 52-week lows now at this point in time. Dutch Bros is a very, very, very successful coffee store chain out there, right? And they want to expand into more products over time, but they're really focused on coffee-related drinks, as well as they have like custom energy drink products and things like that that they sell at their locations. Now, when it comes to Dutch Bros, right, incredible revenue growth for this company. $238 million of revenue for this company in 2019. 2022, this past year, $739 million of revenue. That's about a 3x in the revenue base there, right? Gross profit, meanwhile, has gone from about $96 million to about $180 million, which is about a 2x. And so that is a little troubling, I'll be honest. That's a little troubling with Dutch Bros. I don't want to see a situation where the revenues of a company is increasing much faster than what's called the gross profit. So that's something Dutch Bros has to make progress on here. But they have made some pretty impressive progress on the bottom line, right? $50 million loss down to a $19 million loss. Is 2023 a profitable year for the company? I think it's going to be close. I think it's going to be really close, right? And so this company's on the verge of getting to profitability in regards to the company in general, right? Location-wise, they have less than 800 locations on this company, right? Less than 800 locations. I mean, to put that in context, it's like nothing for somebody like a Dutch Bros. This is Starbucks, okay? Now, can Dutch Bros be as large as Starbucks? I don't think so. I don't think Dutch Bros can be as large as Starbucks, okay? But to put this in context, Starbucks has about 16,000 locations in the United States of America right now. They're likely on their way to about 20,000 locations, which is probably where they'll max out, around 20,000 locations, right? Now, this is a company that back in 2005, for instance, had about 6,000 locations, roughly somewhere in there. And so the way I think about this is it impossible for Dutch Bros to get to 4,000 to 5,000 locations over the next decade? I don't think so at all. I think they can definitely get there, right? I don't know if they can get to 20,000 locations or 16,000 locations, but can they get to 4,000 or 5,000 locations and be in a good position? I think absolutely. And I think that their stores will be very, very profitable, right? So when I look at a company like Dutch Bros, I see a crazy big long-term opportunity for this company, right? And right now, the company's trading at about a $5 billion market cap, roughly. Starbucks is about a $120 billion market cap, roughly, right? Starbucks is probably on its way long-term to being a $200 billion market cap company, right? So if you look at a Dutch at $5 billion market cap, is it impossible for Dutch to 10x that and get to about a $50 billion market cap? I don't think so at all, okay? When I see how busy Dutch Bros are versus Starbucks, and I see how those compete in different markets, because we have a Dutch Bros and Starbucks in Vegas. There's Dutch Bros and Starbucks in Arizona. And so I see like the business Dutch does versus the business Starbucks does. And I can tell you, I don't want to say necessarily Dutch Bros does more business, but gosh, it seems like Dutch Bros does more business than Starbucks does, okay? And so nonetheless, I think Dutch Bros is actually an incredible company that has such a long runway of growth. People just have to have, I think, patience with a stock like this. Patience will pay off because we got to understand the revenue growth coming for this company, the profitability that will likely come from this company, and the amount of locations opened coming for this company. I mean, there's probably going to be years in the future where they're opening 500 plus stores in just the United States. And then you got to think, like, could this company go international? Maybe. It's just right now their opportunity in the United States alone is so big, it's like you can't even think about international, okay? Sixth stock up here is RH, Restoration Hardware, a luxury home, I would call it furnishing company, okay? Now, they also are getting into many other businesses. You know, to be honest, RH, I'm going to need to dive into RH, you know, in terms of showing you guys everything that's going on with RH. It might be featured on a future Stocks I'm Buying video, like my monthly edition, because this one goes so deep, and they're doing so much with their brand and what they're up to there, and I just need to, like, dive in deep. This is such a long video in general because it's 10 stocks I'm covering. We're not going to even touch on everything that's going on there, but I definitely need to, you know, get into all that in a future video for you guys because there's a lot going on with RH. But here's the situation with RH, right? First off, the stock price has been devastated. This was a $700 stock probably about 2 years ago or so, right? Luxury home market's awful right now. Absolutely awful. And the luxury home market is going to continue to be bad, in my opinion, for 2023. 2024, I think, is a wild card if luxury home sales start to come back, or if 2024 is a bad year. But I'm pretty confident 2023 is going to be just as bad as last year, if not worse. Okay, and so what that means is RH's business, in the very short term, is not going to be in a good place, right? But that's when you have to buy a stock like this, because I can tell you, when luxury home sales are booming again, RH is likely going to be a $400, $500, $600, $700 stock again at that particular time. So you're going to miss a huge opportunity. And so if you're looking to get into a play like this, right, it kind of has to be on a year like this, right? Now, in regards to RH, right now, by the way, the market cap's actually trading at $5 billion-ish in that range right now. Expected, obviously, over the next 12 months to be less profitable than the past 12 months, right? And in my opinion, the profitability will likely bottom probably at the end of this year or the beginning of 2024, in my opinion, in terms of their worst case scenarios for kind of net income wise, right? But this company's done an amazing job over the past several years growing their business, right? And this is something I love to see. If you look at the total revenues here, and you can zoom in on the video if you need to zoom in on the video here, okay? They've gone from about $1.55 billion of revenue to 3.5, right? So slightly over 2x as far as total revenues go. But meanwhile, gross profit has over 3x'd for this company. So that's a phenomenal sign that you want to see with the company. If they can grow their gross profit at a faster clip than they can grow their revenues, very good sign, okay? Even a better sign is if they can grow their net income, the bottom line, faster than revenues, okay? So that's absolutely phenomenal. Now, in regards to RH, like I said, they got a tough year ahead over this next year. 2024 is a wild card. I'm pretty confident 2025 and beyond will be very good years once again for luxury real estate. But they got struggling numbers. So if you're going to buy the stock and you're going to take advantage of the opportunity this year, just understand that you're likely not going to see great numbers for this next, I would call it, several quarters. But like I said, by the time they get back to reporting good quarters, the stock's not going to be where the stock's at now. I can tell you that. By that time, I wouldn't be surprised if the stock's $300, $400, $500, $600 by that particular time again, okay? The eighth stock up here of these stocks is actually not a stock. It's an ETF, okay? And this is IWM. This is for basically buying the Russell 2000, okay? This is since September 2018. The index has gone nowhere. Literally nowhere since September 2018, which is crazy, right? And the reason being is Russell 2000 is made up of small cap stocks. Small cap stocks have had to deal with the worst case scenarios, right? Basically, okay? They had to deal with tariffs, which hit all these different Russell stocks super hard. Then they had to deal with Rona, right? A once in a 100-year health event. And then they had to deal with inflation. Now, that hurts all public companies, okay? All companies in general. But I can tell you, the smaller the company, the more trouble they have dealing with all three of those I just named there, okay? The bigger companies, the Apples and Microsofts and all those big dogs that, everybody pays attention to, those ones can weather a storm like that much easier, and still even thrive in an environment like that. The Russell stocks can't, okay? So the Russell stocks have had everything thrown at them, and I just don't think that we're going to continue to have these one-off insane situations thrown at those sorts of companies. And I believe the Russell's actually going to be in a position to actually, in my opinion, significantly outperform the other indexes over the next several years. I'm not talking about over the next several months. I'm talking about over the next several years as we get into more of a normal environment again, where you're not having, crazy stuff after crazy stuff. I mean, think about this, right? Tariffs, we hadn't had to deal with crazy tariffs like we had to deal with, I would say almost ever in the United States, but certainly in decades, right? Rona's a once in a 100-year event, right? Health event. Inflation, worst inflation we had to deal with in 40 or 50 years. So when you put all those things together, those don't just keep happening, okay? And so the Russell's going to be in a great position. This shows you kind of the Russell and the Dow over the past, let's call it since September 2018. The Dow's up about 28%. The Russell's gone nowhere. Now, these two usually move together. Sometimes the Russell will do a little better than the Dow do a little better than the Russell, but I can tell you, not 28 percentage points. This is a freakish time period we've been going through here on the Russell. This is a normal environment, right? And so I took this back previous years, right? 2013 through kind of like 2018 timeframe, right? And look at that. The IWM over that time was up about 77%. The Dow Jones Industrial Average up 76%. Very normal. That's how it should be, okay? So this divergence will not last. It will come to an end. And the Russell will catch up with the other indexes, and ultimately I believe the Russell will likely outperform the other indexes likely over the next 3 years or so, and then they'll be in a normalized environment again, okay? So that's my opinion kind of on what's going on there with the Russell 2000. So IWM definitely, I think, a tremendous opportunity, okay? Ninth one up here, ninth stock is Pfizer stock, PFE, great dividend company. Obviously, biopharmaceutical giant. Stock's been hit very heavily, and it's actually a great opportunity to be a buyer of this stock, okay? It's a cheap company. I mean, trailing PE 7, forward PE 11 on this company, right? And obviously, they got a huge boom from Rona. We all know that, right? And which that has faded off now at this point in time. But remember that all that money they made didn't just go invisible, okay? That money's still there. Let's just put it that way, okay? Huge dividend payer on this one, about a 4% dividend yield, right? Payout ratio under 30% for this company overall. Strong pipeline for the company. And so I look at a stock like Pfizer as a tremendous dividend buying opportunity here. Likely good, nice capital appreciation over the next few years. And I think this is kind of the perfect storm to be a buyer of a stock like this when, kind of everything's down and out here, okay? Last stock up here, number 10 of 10. This one is, we call this a get rich or die trying stock, okay? This is by far and away the riskiest stock of the bunch, okay? Every other stock I named on this list is not risky at all, in my opinion, if you have a 3 to 5 year time frame. This last one is a more of a fun one, okay? This is what I call get rich or die trying, because this stock is high risk and insanely high return depending upon how things go here, okay? But the fun one for the bunch is FUBO TV, okay? This is get rich, die trying at its finest, okay? It's a dollar stock, okay? A $1 stock. This is probably the fastest I've ever seen a company scale from nothing to $1 billion of revenue. I don't think I've ever seen it where a company has scaled that rapidly, okay? But the issue with FUBO is not that they've scaled from nothing to $1 billion that fast. The issue, and now they got all these customers and whatnot, the issue for FUBO is they've been taking insane losses, okay? Absolutely insane, epic losses. And we know the stock market right now in the short term wants nothing to do with any company that's a money loser. And so this company needs to show massive improvements over the next 2 years in terms of getting that net income, net loss into a, let's just call it healthy place, because this is about as unhealthy as it gets for a public company out there, right? David Gandler, he basically, this shareholder was talking about dilution and whatnot. He says, this is correct. Our plan is to achieve cash flow positive in 2025. This is our expectation. We have come out of the gate in 2023 to position the company to be able to do that with respect to content drops and price increases, coupled with the focus on fast channels and ads overall, okay? So if Gandler can pull this off, I mean, this stock has so much upside. It's one of the highest risk-reward profiles I can find out there in the market overall. It is the highest. I can't find a higher risk-reward profile out there, okay? Now, the other thing with FUBO is possibility that the other companies could invest in a FUBO, being that it's a huge money loser, but they could make progress over the next few years to get into a healthy place. But also, remember, they're attracting crazy amounts of new customers right now, and they've scaled this business from nothing to $1 billion like in a snap of fingers, right? And so, I look at a company like Dish Network, right? Dish Network's best days are long gone, right? When everybody it was kind of the peak of satellite TV was kind of in the 2005 through about 2000, I would say 14 or so, okay? That kind of roughly decade there was the pinnacle of satellite TV, right? And you had DirecTV, you had Dish Network absolutely dominate. Well, Dish Network has been absolutely hammered, right? But the company, although it's valued at kind of joke prices now because people view it as not the future, right? They still hold a ton of cash on the balance sheet. They could easily either acquire FUBO if they wanted to, or make a major investment in it, so it allows them to prosper as a company like FUBO that's next generation, right? All focused around streaming prospers, right? I even think about a company like Disney that has $11 billion on the balance sheet that could make a move for FUBO. Remember, Disney owns ESPN, and remember what FUBO is focused on. It's focused 100% on sports. I mean, they have other programming, obviously, but, if you're going to sign up for a streaming player and you're really into sports, you're going to sign up for FUBO, right? Like, I'm a sports fan, especially when it comes to college football, right? In NFL football as well, but college football really. And so FUBO is the best service for me. That's why I'm signed up for FUBO, right? And so, I mean, with Disney owning ESPN and so many of the other sports networks, it kind of is a match made in heaven, in my personal opinion, in regards to that. And we know, Disney wants to get bigger and bigger. If they made an investment in the company, they also don't have to recognize the losses FUBO takes in the short term, which we know, obviously, big boss dog coming in now at this point in time, right? He's very focused on profitability for Disney, right? So would he want to buy FUBO and have them that bottom line? No. But could he make an investment in FUBO? Ooh, that's where things could get interesting, making a nice investment in FUBO. And as FUBO prospers over time, obviously Disney's can actually take gains on that, right? They can take gains on that. It would actually positively affect their net income because of the way you have to do accounting standards nowadays. If FUBO stock price went up and up and up over the coming years, they make it through and everything's fine, right? Meanwhile, Disney can maybe give them a capital infusion and make sure they are 100% fine for the next several years as they get to cash flow positive. That could be intriguing. And they don't have to recognize a loss unless the stock went down a ton more. But is the stock really going to go down a ton more? No. And also, unless, well, of course, the company went out of business or something like that, but at this point in time, I think it's unrealistic. And if Disney's an investor of it, I would say the stock would double or triple up in like a snap of fingers. And so Disney wouldn't even have to worry about any losses on the as far as the bottom line goes, right? So that's an intriguing proposition there as well, right? And when it comes to FUBO, it's a market cap in the $200 to $300 million range now at this point in time, okay? And so, like I said, is get rich or die trying in regards to this one. This one's either going to, not make it, but I have a hard time believing a company's not going to make it that's scaling the way FUBO's scaling. They're attracting as many customers as FUBO's attracting. Their revenues are skyrocketing the way FUBO's skyrocketing, right? I have a hard time thinking that company's not going to make it. I think there's a pretty high probability they're going to make it through. And if they make it through, that's where the insane upside is for a company like FUBO overall, okay? Just the question is, do they get bought out? In the meantime, that's another thing to consider, right? But let's get rich or die trying in regards to that one. So appreciate everybody joining me as always. Hope you got good value out of this. Let me know in the comments if you did and you enjoyed a video like this, me going over these sorts of companies. There are some dividend stocks in here, some value stocks, and some growth stocks overall. If you're looking to learn directly from me and apply to join my private stock group, the private wealth group, that will be in the description area for an application for that. If you're looking to join my Patreon, see all the moves I'm making in the market and the stocks I bought here today, then check out the pinned comment down there. Much love and have a great day.